Hello and welcome to the Triple Point Impact EIS webinar. My name is Belinda Thomas and I'm here with Ian Clennon, who is a partner of Triple Point and head of our venture team, and also Julian Pixton, who is our head of social investment. And I lead the sales and investor relations team. So what we thought we'd do today is to do a deep dive into our Impact EIS service, looking a little bit about the EIS marketplace, and then really just having a look into some of the current investments that we've done over the last few months, and also looking at the future pipeline. So for those of you who maybe don't know Triple Point that well, we were founded back in 2004, and we manage funds on behalf of private individuals, the government and institutions. Triple Point's investment philosophy has always been on trying to reduce the level of risk in an investment, and we invest across 4 key areas. We do venture capital for our venture capital trust and our Impact EIS. We do debt for our income service and the estate planning solutions. That's our leasing and lending strategies. We also do energy and infrastructure for our historic EIS and VCT, and also that's where our government mandate sits. And finally, we also do property in our social housing REIT. We manage over 1.4 billion, and Triple Point members now number over 110. So looking at what is an EIS, so I'm sure that most people listening into this webinar are probably quite familiar with the EIS marketplace, so I'm not going to dwell too much on this. But as a reminder, the Enterprise Investment Scheme, EIS, is a series of UK tax reliefs. It was launched in 1994 in succession to the Business Expansion Scheme. It's a government-promoted tax relief, really just to encourage investment into small and growing businesses. And in return, the government provides a variety of tax reliefs, including up to 30% income tax relief, qualification for business relief after 2 years, gains are free of capital gains tax, and loss relief is also available should companies fail. In return, there are various tests to ensure qualification under the scheme, and investors need to hold their shares for a minimum of 3 years. Now, many of the EIS services available in the marketplace are largely based on tech-based investments. And in contrast, our service is focused on filtering companies so that they have a positive impact on society. It means that our service can act as a diversifier to the market, not just by manager, but also by the focus of the companies, including a social outlook. The EIS market is a sizable area of investment and, of course, a great opportunity for advisors.
Thanks, Belinda. The Triple Point Impact EIS service doesn't just have all of the benefits of EIS, it also has 2 other key attractions. Through investments in unlisted smaller companies, the Impact EIS service both provides exposure to companies with growth company financial returns and significant social impact. We define social impact, or impact for short, as the contribution that an organization makes to society. Increasingly, investors in for-profit companies are looking not only to achieve strong financial returns, but also to generate significant impact. Academic evidence suggests that there is no financial trade-off between impact and financial return. In other words, impact investment makes it possible to do good and to maximize returns, as well as benefit from EIS's advantages. The Impact EIS service focuses entirely on impact investment, but there are other types of investment with a social purpose. So to avoid confusion, which is common in the impact world, on this slide we'll try and define where our impact investment sits. On the left side of the slide is ethical investing. Ethical investment differs from impact investment as it avoids social damage rather than positively generating impact. On the right side of the slide is social investment. Social investment aims to provide significant social impact, but unlike impact investment, this is usually because of financial concessions made by investors. Impact investment, in the middle of the slide, maximizes both financial and impact returns, and that is what we are doing.
Thank you. So, having a look at our Impact EIS service. So it's a managed service where we will select between 8 and 12 companies for each investor. We anticipate it will probably take between 12 to 18 months for an investor's funds to be fully deployed, But of course, this is subject to the pipeline of opportunities, and Ian will talk about those a little bit later. Each company that we select for this service is seeking a combination of financial return, so each holding should have the potential to increase in value by 5 to 10 times, probably over a 5 to 7 year holding period. These financial returns are combined with providing a positive impact on society. Through the EIS service, investors will be providing scale-up capital to growing businesses who have proof of concept for their product or service and are revenue generating. The service has the ability to invest up to 10% into companies which we believe offer the potential of strong returns, but are at an earlier stage of their life cycle, so possibly without meaningful revenues. But overall, the service has a maximum concentration limit of 20% into any one company. Impact investing transcends how TriplePoint manages all of its products. The key differentiator with this service is that on an annual basis, we'll report investors with a monetary value for the impact that their investment has made.
Okay, I'm going to run through a few slides which go into investment selection and financial returns, and then later Julian will follow up on how we look at impact. So this slide, in a typical year, venture team sees around 1,000 investment opportunities. These are coming in from all sorts of sources, either from our venture network of advisors, consultants, accelerators, and angel syndicates, or they come from our own outbound origination work as well. So once we've got the opportunities, first of all, we filter them for 3 key factors. First of all, of course, are they EIS qualifying? What's the stage of their revenues? And also, of course, whether they have a positive social contribution. By the time we've done that, we usually end up with a couple of hundred companies that are actually worth us meeting. For the more interesting opportunities, we then go through a more rigorous process of vetting, often including a review by our advisory committee, on which I'll say a bit more later. We take the best opportunities to an informal investment committee session at TriplePoint, where our most experienced minds get an opportunity to test us on the venture team on the investment theses, and also suggest additional avenues perhaps for our due diligence. And if after that we decide to proceed with the investment, we will issue a term sheet to the company and commence more formal DD work, including the legal work and any specialist technology or accounting DD that we think is appropriate. And at the end of this, that's when we get to our aim of closing 8 to 12 EIS investment completions per year. I did just want to highlight that we have 3 external advisors specifically for Impact EIS, the Impact EIS service. Their primary role is to help us commercially evaluate potential investees, but they also assist us with origination and with advice for the investee companies themselves sometimes as well. Just looking at these guys, Michael Wood, co-founder of Receipt Bank, is a successful software and automation entrepreneur. Michael's particularly helpful to us in terms of the analysis of software company business models and what their plans may be to scale their businesses to attract later stage VC funding or exit, something that Michael has been through successfully with his own business. Henry Carlton is a serial entrepreneur who's successfully grown and sold businesses selling software and services into the health sector, particularly with the NHS as a customer. And he's got a fantastic network of health sector contacts. And he also has experience, like Michael, of what is required to scale a business for significant growth in valuation. And Simon Ackland is a long-time TP associate and is an expert on early-stage environment sector investing. He's director of the award-winning Green Angel Syndicate, of which TriplePoint is a corporate member. And before he was involved in that, Simon spent many years investing in tech. So just looking at what we're considering commercially in an EIS investment in order to find companies that will potentially achieve 5 to 10 times returns. Obviously, there are a lot of factors. Just to pick out a few of them that we think are particularly important, there has to be a large potential market for the company's product, running into the hundreds of millions of pounds. So that even if our investee company ultimately only captures 5 or 10% of that market, their revenues are still going to be strong enough for us to be making money for our investors. We also look for companies that are solving a clear customer problem and where we at TriplePoint can really understand why the return on investment for the customer is attractive. One recent example is of an investment we've done is Dr. Focused, which has software that helps healthcare businesses to digitally manage the plethora of documents and compliance involved in hiring and managing health and care professionals. That product reduces a lot of the admin pain for customers which have frequent professional staff turnover or that are growing rapidly. And of course, we analyse relevant financial metrics, whether they're fairly simple ones like recent growth in revenues, or specific sector metrics such as customer acquisition costs and customer lifetime values in the software sector, which we can then benchmark against successful peer group companies. So post-investment, our impact EIS capital is typically invested in scaling up the sales and marketing resource for an existing product, as well as enhancing the product's capabilities. We're not financing basic product development. We are financing expansion by companies that already have a commercially viable product. Before and after investment, we work on ensuring that our entrepreneurs are getting the right advice. So, for example, with a health sector company I mentioned earlier, we asked as a condition of our investment that some of our funds were spent on retaining and incentivizing two health sector experts as advisors to the founders. In some cases, TP will provide direct additionality in areas where we have expertise in-house or access to such expertise, like the NHS, such as the social housing sector, and like software as a service. Once we're invested, of course, we actively monitor progress, either as a board director or as an observer, including monitoring impact metrics as well as commercial metrics. And of course, we're always looking at exit plans at the time that we're investing and making sure that we're aligned with the investee company founders. Typically, they'll be targeting their own individual exits in 3 to 6 year timeframes, hence our own overall target of a 4 to 7 year period to return funds for the impact EIS. Speaking of returns, this slide shows some scenarios for returns to the EIS investors. Our base case scenario looks for £1.68 of exit proceeds per £1 originally invested by the investors, which, including tax benefits, would in total return £1.93 per £1 to the investors. That scenario is based on an assumed investor portfolio of 10 companies, of which half of them eventually fail or end up as dead money, but where 3 of them double our investors' money and 2 of them increase in value by 5 times. We then take into account fees and tax benefits to get to the £1.93 total return. The scenario also highlights one of the attractions of having an EIS portfolio for higher rate taxpayers, which is the loss relief which investors can receive on individual failed investments, even if their overall portfolio has done well. Clearly, we do aim for all our investments to have that 5 to 10 times return potential, but it is in the nature of early stage investing that there will also be some failures. So we've also included here an upside and a downside scenario based on different assumptions for portfolio performance. Now, Julian is going to tell you something about our impact process.
Well, Ian, I'm going to tell them that our impact process is just as rigorous as our financial process. We employ rigorous methods to assess and monitor impact companies. We place all potential investment companies into one of 4 impact themes that reflect significant societal challenges. The themes there at the top of the slide are a simplified version of the 17 UN Sustainable Development Goals. They are, as you can see, environment, health, children and young people, and inequality. We assess the impact of each potential investment using a 5-stage process. We like companies that address large social issues, companies that have products and or services that are effective, companies that significantly serve the disadvantaged in society and are innovative, and also companies that can gain an advantage by utilizing TriplePoint's areas of expertise. After investment, we collect impact data to estimate the value of impact that a company has generated, and we use a proprietary process called the monetary value of impact, which we provide to our investors. This slide provides a summary of how our portfolio has developed over the last year. To date, the Impact EIS service has deployed capital in 7 companies, and we have deployed capital in all our impact themes. We have 3 companies in the healthcare sector, and that's at the top left, 2 in the environment below, and 1 each in children and young people and inequality. We expect to have provided EIS 3 certificates to 5 companies within the next month. So now I will talk about some of the companies that we've invested in a little bit more detail. The first company I want to talk about is Grippable, a company in the healthcare theme. A surprising statistic is that 2/3 of patients with strokes and other upper limb problems do not perform the exercises that doctors tell them to do. To a large extent, I think this is because most of the equipment used in rehab is surprisingly simple. Things such as therapy putty, squeezy balls, pulleys, and rubber bands. And it's pretty clear that using that equipment is not that effective. Now, Grippable is a spin-out from the medical faculty of Imperial College London and is looking to change this way of addressing upper limb problems through its technology. The key to its business is the development of a finely adjustable digital hand grip. The grip can be used in multiple ways and provides data that enables medical staff to monitor patients. In addition, to encourage greater take-up of prescribed therapy, the hand grip can be used with video games that respond to patients' hand and arm movements. I think it's much more likely that a grandfather with a stroke will do his exercises by playing a computer game with his grandson rather than squeezing some therapy putty. We believe that the clinics that use Grippable will generate a positive ROI as the product not only improves patient outcomes but cuts costs through earlier patient discharges. For clinics buying the product at a time when patient numbers are growing, these are very important considerations. The next company I'll talk about is We Are Digital, which is a company in the inequality theme. We Are Digital provides training for people lacking digital and financial skills. There are at least 3 million people in this category in the UK. We Are Digital supplies training services predominantly to housing associations, central government and high street banks who want to provide support for their less advantaged customers. People without digital and financial skills are generally among the most disadvantaged in society, such as people on disabilities, benefits, or who are unemployed. The potential for generating significant impact is therefore high. We Are Digital's competitive difference is its network of more than 120 tutors. Understandably, the digitally excluded population need face-to-face tuition rather than online, at least initially. We Are Digital has doubled its sales in the last 6 months. So this is not a business which is just about social impact, it's about financial returns as well. Ian will now talk about a company from the environmental field.
Yeah, NatureMetrics, and we've got the great crested newt to thank for the origins of this company. The great crested newt is a protected species, and all sorts of property and infrastructure developers, from house builders to solar farms, historically have had to employ biologists to go on site and trap newts or search for other physical evidence of newts or other protected species in order to prepare the required environmental reports to get planning permission. Well, that physical process, of course, sounds rather outdated and inefficient. So NatureMetrics introduced environmental DNA testing to identify the presence of newt DNA. That involves taking a small sample of water or soil from the site, which is then analysed for DNA back in the laboratory, allowing NatureMetrics to produce a biodiversity report on the site where the building project is proposed. That's proven, of course, a far more efficient and a more systematic approach to biodiversity sampling than the old way of doing things. Since then, NatureMetrics have vastly expanded the number of individual species DNA that their laboratories can identify, and they're now targeting growth internationally for major environmental impact assessments, or EIAs as they're known. EIAs are required for major infrastructure projects like pipelines or highways, required either by governments or by international lenders who, whether they be the World Bank or private lenders, will generally not provide finance without environmental impacts being assessed and monitored going forward. The company, this one's run by a fantastic founder. She's put the company at the forefront of standard setting for this sector, environmental DNA testing, and NatureMetrics are using some of our funds to gather proprietary biodiversity data from key global environments such as the rainforests. So that's an example of 3 of the companies we've invested in so far. Looking forward, in terms of our deal pipeline, the team are currently considering 14 investments across the 4 themes that are again highlighted there. 2 of those investments are at an advanced stage where we've already got term sheets signed. We've already been to our investment committee for initial approval. One of them in the health sector is a consumer food business specialising in vegan and gluten-free desserts and confectionery products made from all natural ingredients. The second is very different. It's in our children and young people theme. It's a Scottish software business, a university spin-out again, that has a software product allowing the police force to quickly scan suspects' devices for illegal images or content. So those are the 2 that are most advanced as we speak. As is typically the case, there are 12 other eligible investment businesses that we're looking at, having had discussions with management teams already, and then we're now working on further DD across all of those. Of course, after the filtering work that we do, we will probably only end up investing in 1 or perhaps 2 of those dozen others, but that group of target investments turns over every 6 to 8 weeks or so. There really isn't at the moment an issue with finding potential investment ideas. The issue is to filter them down for the good ones. That's what's key.
Excellent. So no presentation we can complete without looking at fees. At TriplePoint, we always seek to align our interests with those of our investors, and obviously this is reflected in the way that we take our fees. We have an initial fee of 2.5%, and our annual management charge of 1.5% is for a total of 6 years, so it stops at that point. Years 1 and 2 are retained at subscription, so that 93.4 pence in the pound is available for tax relief. Years 3 to 6, the annual management charge is only taken once exits occur. We have a performance fee of 20% on the excess returns over £1.10 for each £1 invested in the service. We're also able to facilitate both ongoing and initial advisor charges. These sums are retained at subscription, so they'll also reduce the amount on which tax relief can be claimed. But do bear in mind that we can facilitate those for you if it's helpful. As I mentioned at the start of this webinar, impact investment is a theme throughout most TriplePoint investments, and 10% of any of our incentive fees for the EIS will be paid into social causes. So we're trying to pay back into the companies and social causes that we're supporting. So in summary, you've heard a brief snapshot of the EIS marketplace and how TriplePoint's impact EIS service fits into this with its unique focus. Once again, through the service, investors will be allocated shares in 8 to 12 carefully selected companies, each which have the potential of significant financial returns. So through supporting companies who are promoting social good, essentially enabling investors to do well by doing good, as the more financial return produced by the company results in more impact. The important information slide is something that I'll sort of let you cogitate on. Whilst we've been talking, there have been a few questions which have come in, which is great news, so we'll get to those in a moment. If once we've finished talking, we haven't covered your particular question, or you think of the killer question that you want TriplePoint to answer for you, then please do contact either your usual TriplePoint contact or the sales team on 0207 201 8990, or alternatively send us an email to contact@triplepoint.co.uk. Okay, questions. First of all, what is the liquidity of the service? I'll take this one on. So in terms of the liquidity of the service, really, because it's an EIS service, there isn't the ability to come out before an exit is generated. So people do need to bear in mind that we're looking for exits hopefully within 4 to 7 years, but it may well be longer than that in terms of returning cash back to investors. Of course, with it being a service and these being holding in shares, there is the ability for the shareholding to be transferred to another beneficiary at certain points. So it's not that can't be done. Another question that has come through is, how much have you changed your investment approach since 2017? So back in 2017, just went in my mind back now. So really, as I said, impact investing is something that TriplePoint has been doing right the way since the beginning and since we were founded back in 2004. I suppose impact investing in particular, Julian, did you join us in
2015.
2015, thank you. And at that point, we were looking at social impact tax relief, and we have an SITR service, which we started doing in 2016, I think it was. Yep. So we've been really focused on that in those areas of the business. And we started doing our Impact EIS service at the beginning of sort of February of last year. So quite a while. We don't really see it as being a change in our investment approach. It's more that we're able to be clearer in this particular product about the benefits of combining that financial return with impact. To what extent will impact investing become the norm? Julian, definitely for you.
Indeed, thank you very much. Well, I think we're already a long way to reaching that norm. If you look at the GIIN, which is, what does it stand for? The Global Impact Investing Group, sorry about that. They estimate that there is already 500 billion of impact assets under management in the world. Also, I think it's quite interesting that the UK government has changed the fiduciary rules for the pension scheme, to allow trustees to consider impact when they are making their decisions. But perhaps my favorite way of presenting this is that we'll know when impact has become the mainstream when we don't need to put impact in front of the word investment.
What impact could a hard Brexit have on the ability for startups to access funding? I'm definitely going to dodge this one. Ian?
Right, okay, the hard questions. Starting off, I guess it's interesting that so far, the last 8 or 9 months, there's been quite a bit of heightened uncertainty around Brexit, but that doesn't seem to have stemmed the flow of either opportunities or venture capital funding. Why is that? I think it's partly to do with the relative resilience of the economy, but maybe more importantly, because I think the venture capital cycle and the innovation cycle is a global phenomenon. So I wouldn't see that being destabilized by Brexit alone. However, I do think it's right to run our portfolios and look at our investments, bearing in mind that in the scenario where there was a no-deal Brexit, there might well be a hiatus in terms of investment funding for a bit, while investors want to judge whether or what impact there is on the economy. So the way that we can manage that is, of course, when we make our investments, one of the things that we're looking at here is what sort of cash or capital runway the companies have. And we're only going to be investing, of course, in the next few months where we know that the companies have at least 12 to 18 months of financing already under their belts. And then longer term, I would imagine that whether or not it's a hard Brexit, as we get greater clarity, that there will be a rebound in investment in the UK, including in the venture sector as well.
Okay. What is your pipeline of upcoming deals? Again, I can dodge this one happily.
Well, I've touched on it a bit. So I mentioned the ones that we're doing in the immediate future, which are the digital forensics company, which is selling to UK police forces at the moment, and to sort of emphasise the diversity of the products we've got or investments that we've got. The other one that we're most advanced in is actually more consumer-focused company producing healthier confectionery for the mass market. And then beyond that, I had a quick look before I came in terms of the 12 or 14 other companies that we're working on in terms of the sector split, and reasonably evenly split, but there are more ideas really in the environment and in the healthcare sectors than perhaps the other two, but we do have ideas from all over.
Okay. What is the diversification of your EIS product?
So, as you've mentioned, Belinda, we will make sure that every investor has 8 to 12 investments. The investors who've been in for a year or so, I think, will end up with 11 investments, just as an example. So that's one answer. In addition, we have the different sector themes. So as I mentioned, there will be some exposure, say, to software, some to more consumer-focused businesses, etc. So there's a bit more diversification sector-wise there. We have a concentration limit of 20%. So, I mean, clearly, if we're looking for 8 to 12 investments, we're unlikely to be putting as much as 20% of a portfolio into one company, but 20% is the maximum. And then one other thing to mention is, of course, that we are also making sure that 90% plus of portfolios will be invested in companies that are already, as I've described, revenue generating. So I think taken together, given that it is early stage investing, that's a reasonable approach to diversification.
Okay, thank you very much. So thank you very much for listening in. I think we're going to draw up stumps there. So if you do have any additional questions or anything like that, then please do once again give us a call. Hopefully the any questions slide is up in front of you now, so you can see our contact details. The great thing I think about the EIS service is the fact that whilst it is unashamedly looking for that blend of impact and also financial returns, when you're looking at your client bank, and hopefully we've sparked some interest for you in terms of clients that this might be suitable for, it doesn't necessarily need to be someone who is wholly focused on impact investing. Just because we are positively selecting these companies that have that societal benefit, as I said before, the way that they are maximising the amount of impact they have is by maximising the amount of financial return. So I think that this EIS service is actually quite a broad church, and it can be appropriate for quite a few clients with all of their different needs and wants. So thank you very much for listening in, and hopefully we get to speak to you soon. Thank you.